Welcome to the Nexus Point. We are Rich Romero and Geoff Bruskin, and this is the podcast for next generation accounting firms. Welcome back to the Nexus Point Podcast. As always, I'm your host, Rich Romero. I am here today with managing partner and CEO of White Tiger Connections, Geoff Bruskin. How you doing today, Geoff?
Better now that I'm hanging out with you, Rich. How about you?
I'm doing well. Weather's nice. We're getting closer. It is spring. We're getting closer and closer to summer, and that's my favorite time of the year. But we got an exciting conversation to get into today. So let's jump right into the world of firm valuations and gross revenue multiples and adjusted EBITDA multiples, and they can tell very different stories. So today we're gonna break down why the difference matters, how private equity and independent owners are playing the game, and what owners need to know to avoid leaving money on the table or overpaying in a deal. So the first thing I want to jump into first is just walk us through the basics of like what the real difference is between a gross revenue multiple and an adjusted EBITDA multiple are in today's market.
So gross revenue multiples, Rich, don't really have a science to them. They're more just like the kind of shooting from the hip history of the professional services landscape. This is especially true for tax preparation and bookkeeping shops. For the last 50 years, 100 years, as owners retired and the next generation of folks took over their business, either inside of a company or somebody rolled a book of business into a larger firm upon retirement. They would calculate roughly 1 times earnings, 1 times revenue, paid out over X number of years. This could be in pension. This would be what would be described as like a pension for somebody who was kind of deeply integrated into a multi-partner firm and retired, and it 0.8 times revenue paid out over 8 years, 1.2 times revenue paid out over 6 years. You can do the math. The structure lines up nicely. It also keeps the previous owner of the relationships on the horn in a goodwill-driven environment. Once private equity came and started participating in professional service, of course, private equity just essentially means outside capital, right? So you don't have service providers who are necessarily native to the profession who are owning the relationship or owning the goodwill. Then, like everything in the world of private equity, coming down from the way that public markets are traded on to the way that private markets are traded on with outside capital in any ownership of business, there's sort of rules of engagement regarding the way that quality of earnings reports, pro formas, for that matter, the way that private institutions like banks will consider funding and setting amortization rates in the context of interest rates on debt service coverage. And ultimately, all of that boils down to adjusted EBITDA multiples. And so the reason why the adjusted thing is so important is because you have, as a business owner, normalized expenses that are going to be deducted from your from how your EBITDA is calculated. And the biggest one in goodwill-driven businesses, Rich, that we see all the time is the salaries of the owners who are working in the business, not on the business, right? On the business would mean that an owner is not intimately involved in day-to-day operations. In the business would mean that an owner is intimately involved in day-to-day operations. And so if an owner is selling the business, not surprising, the way that the bottom line is calculated is going to have the reduction of what the owner's fair market salary for the in the business work that they are doing, because the buyer has to consider things like debt service coverage ratio, things like their pro forma in the context of the owner's continued involvement, and then ultimately what the cost of replacing the owner would be. So it's a little bit of an oversimplification, but gross revenue multiples don't have really a ton of science with them. It's more the legacy way that professional services firms are evaluated, whereas adjusted EBITDA multiples are the result of outside capital entering into the market. Can certainly go into more depth, but that's the basics.
Yeah, I'm sure we'll cover a bunch of things though, but very different sides of that coin, and they tell different stories. And so just in your experience, you maybe touched on it just now a little bit, but in your experience, what kind of adjustments are buyers most aggressive about making, and which ones do sellers kind of fight the hardest against?
Yeah, so it's a great question. So I would say definitely the normalization of the seller's salary in the business context is like the one that comes up, the most regularly. One-time expenses, kind of, quote unquote, anomalous expenses or expenses that are not required for regular business operations is, the way that, for example, attorneys who consult on M&A transactions will typically advise clients. Those are also fought against. So, for example, let's say that you run $1 million business, you have $500,000 of kind of regular expenses, and then you've got your salary on top of that is 200 grand, and you're the key person in your business. Even if you draw only 120 out of the business, maybe a buyer is going to argue, well, it's going to cost 200 to replace you for your function. And so now your adjusted EBITDA drops to 300,000, but maybe you did a recruiting search for, an executive assistant that year, and that recruiting search cost you 25 grand because your previous executive assistant retired. So you are going to maybe take a hit to your 500 of 200, but then you're going to add back the 25,000 that was the one-time recruiting expense. Your adjusted EBITDA is calculated at 325. So those are just some examples, and ultimately, yeah. So it's regular business expenses. The buyer, of course, is going to argue that things that are in your P&L are regular, and therefore they should not be deducted. They should not be added back, as it were. And the seller is going to argue, well, sure, I'm involved in day-to-day operations of the business, but it's only 30% of my time. And fair market salary for this position is 200 grand, and 30% of 200 grand is 60,000. And therefore I should only have my, EBITDA adjusted downward 60 grand, something like that. So these are the dynamics that we see regularly at play.
Again, more nuance, and it's always great with when you get to speak to someone who understands those nuances. So that's very important. With private equity kind of, really pushing in this market, we've seen them push multiples on deals. And, just talk me through like when that might make sense, or, when as a seller, it may be like a red flag, and just certain experiences that you've maybe had with that, or just kind of like when in your advisory roles and things like that.
It's another great question. So, I'm maybe a little bit different, Rich, than a lot of other brokers. I don't pay as much attention to the finances, which is like probably a blasphemous thing to say. I really listen for both on the sell side and on the buy side, and we do work on both sides of the table. What's kind of the fairness signature that I'm getting, the engagement signature that I'm getting from each party. The more that the party feels to me like they think they know everything, either the seller or the buyer, the more cautious I am, and the more detailed I'll ask questions and kind of, qualify that party out from being a fit of working with us. And by the way, we work with, buyers, for example, who have done 60, 70 deals in a particular profession. We work with sellers that they're selling their fifth or sixth business. And there still is a signature of humility, open-mindedness, market awareness, even if it's as simple as, Geoff, what are you guys seeing in the market today? It's like, they're interviewing us as we're interviewing them, very much about the way that someone is going to approach a sort of negotiation. And certainly we do talk about multiples. The other thing that we talk about a lot in like an initial sort of qualification environment is deal structure. How much cash at closing, how much promissory note, how much earnout based on revenue retention or EBITDA retention, and how much rolled equity or growth incentive. Those are the key terms, of most deals in this space. And so because we do this all day, every day, we can usually get a sense pretty quickly of whether or not we're working with someone that has aggressive, on the buy side, that's going to have aggressive desires and be willing to back those up, and that's a good investment of our time and our sellers' time to put them in front of those folks. Similarly on the deal structure side, the way that they think about cash at closing, the way that they think about owner involvement, what their thesis is, how much time they might like an owner to stay involved. There's so many variables. They actually are all mappable. And so it's really just, I would say, a strong intuitive sense, at least until we have, ChatGPT or whatever map out kind of every single solitary, spectrum, and you pull on one thread and the other gets adjusted accordingly, right? So we just listen for fairness, is maybe the simplest way of saying it. And that's true on the sell side too. Sellers who come to the table with gross expectations. And unfortunately, there is some of that, because a lot of brokers and attorneys who maybe don't do this in a particular profession like we do with accounting and wealth management all day, every day, they might overinflate expectations. And so sometimes, they can come to the table with very, inflated expectations, and we can speak reason to them, and they're able to kind of say, wow, well, that actually makes a lot of sense. So we can back up the things that we say, because everything is rooted in market experience. And when you look at the pro forma, things like debt service coverage, what it's going to take for a bank to participate, kind of the typical rules of engagement for private equity, as well as where and why and when parties will stretch beyond those typical rules of engagement, we're able to educate buyers and sellers about those things. And so, yeah, I would say that's what makes us a little different.
Yeah, I appreciate that. And it's always about coming to, the table, having like proper expectations. And we definitely do we have conversations with plenty of folks who have those overinflated expectations just from other people who have maybe burned them or led them down a rosier path than they should have been. But for the type of firms that we're working with all the time, whether they're selling or buying, how should they be thinking about multiples as we continue on into 2026? And a few weeks ago, we talked about into the 2030s and all of that stuff. Just how should they be thinking about this with rising interest rates? The economy, laws and tax laws are always kind of changing. So many things are changing, and there's also a lot of tech, like you've been touching on too. What are the ways that they should be thinking about this as we kind of lead down, into the future?
Hopefully interest rates are falling, not rising. We just got a no change notice maybe a week ago now. It's March 24th as the recording of this podcast. I would say it's an interesting time. I'd say the biggest kind of next checkpoint as of the recording of this podcast, Rich, is the midterms. There's a lot of question about, what's going to happen with the midterms this year. How is that going to affect kind of this gangbusters environment that we have with multiples just being explosive? And so we certainly are working with a lot of sellers that are concerned that there's going to be a change of some kind when the midterms hit. And so they feel that now is a really good time to sell. On the other hand, the buy side appetite is absolutely voracious. And there are a lot of folks who, maybe they think that there's going to be a blip on the radar. Maybe they don't during the midterms. And as we round the bend into next year, 2027, but there's just a thesis which kind of has a durability beyond 4.5 versus 5.2 times adjusted EBITDA or whatever it is, in terms of, kind of where the adjustments shake out. There's also just a ton of uncertainty around AI, right? Because, is AI going to make it so that the 1040 is no longer relevant? Is it going to make it so that tax advisory is no longer relevant? Is it going to make it so that bookkeeping is no longer relevant, or CFO work is no longer relevant? And my belief on that, Rich, is that in a vacuum, yes, it's going to make all of those things less relevant, for service providers to do. We got robots coming for, plumbing jobs, for crying out loud, in the next decade. Professional services is not immune to AI. And I think there are certainly ways of defensively and offensively taking advantage of some of the trends in AI. We've done, stuff on that, content on that. We'll do more, I'm sure. So I would say it's a great time, maybe just in summation, not necessarily to sell, perhaps to sell, but if you're not going to sell and you're thinking about it, you should absolutely have a plan and a reason as to why not. Prayer is not a strategy.
Yeah, it makes a ton of sense. Next thing that I kind of want to get into, because we've talked a lot about on this podcast, just about the integration between the wealth profession and the CPA and accounting and tax profession. Do you think that is going to have an effect on which multiples mean more, or where the market kind of leans toward, or anything like that? It's obviously something we believe is happening, and we're working on always with clients and having those conversations. But just kind of wanted to see what your thoughts were on that.
So it's a great question. I think always remember, beauty is in the eye of the beholder. So there's not necessarily a hard and fast rule around this stuff, but there are dynamics, that we see at play based on the narratives that we are able to tell to our clients and, buyers in the market, certainly. An accounting firm that's doing, 5 million in revenue and has a $2 million seller discretionary earnings, and the owner is, principally involved in client relationships, might sell, I'll just use round numbers and not get into too much depth around valuation or deal structure dynamics, $10 million, right? Whereas a wealth management firm that's doing 5 million in revenue and has $2 million in seller discretionary earnings might sell at 15 to $20 million. And so again, I'm using round numbers, right? But those are some of the things that we're seeing. Imagine that accounting firm like is 2 million today in revenue and 400 in seller discretionary earnings. And in the next 5 years, they're going to build towards being that $5 million firm with 2 million in discretionary earnings. Well, maybe part of how they get there is by developing a wealth management arm. And now, of course, don't freak out, listeners, right? There's a whole slew of things that you have to consider in terms of how you do that. But just hang on and bear with me for a second. If you are successful in, let's say, 40% of the revenue that you generate is wealth management, revenue, and you're at 5 million in revenue 5 years from now and 2 million, but 2 million, 2 million in discretionary earnings, but 2 million of that revenue, right, is financial advisory, wealth management revenue. There's absolutely a case to be made for someone buying you at 15 to $20 million. And so, why is that? It's not apples to apples, certainly, but arguably, you even have done something more impressive than the $5 million firm that's pure play financial advisory, which is that you've built an integrated service model that now the buyer is equipped to take and to scale to $50 million, where either in the scenario of the 5 million pure financial advisory firm or the 5 million pure CPA firm, it would be harder for them to achieve that economy of scale because they don't have the interconnected synergistic services that you do have. So a lot of this is narrative and kind of contingent to where the buyer demand is and who your advisor and your representative in the market, and for that matter, your consultant is, and how they guide you over the years ahead. Long-winded answer, I definitely think there is value to be had in the integration of these professions, especially financial advisory, financial services broadly, and the CPA services model, especially if you are not planning on trading in the next 3 years. If you are going to strap in past 2028, 2029, even just to 2029, 2030, I think you're silly, regardless of where you are, whether you're a financial advisory firm or CPA firm, not to seriously consider adding the additional service. Oh man, that's a hard one. You giving me like layups before this. What? Yeah. So here's a good one that happened yesterday. So I have a client. They're about 5 million in revenue, about 1.5 million in seller discretionary earnings. Two partners, CPA firm, and they're both within 10 years of retirement. Let's just put it that way. Primarily tax, also accounting in their business, and they're a consulting client of ours. And they, have engaged us to help them evaluate kind of what the next 3 months, 12 months, 60 months is going to look like. We've met their team. We've advised them on already on their P&L. We've looked through that in a lot of detail, their software stack, their service matrix, obviously, talent acquisition sort of dynamics, price increases, kind of all manner of sort of COO services where they're essentially fractional COO. That's the engagement that we have with them. And so we put together a pro forma, which was helping them get from 5 million basically to 10 million in revenue in the next 5 years, and totally achievable. 1 to 2 acquisitions, of small size, price increasing, selling some of their less than positive business, maybe using some of that to start a financial advisory practice. And there's a lot in there over the course of 60 months, but where they are today, it's an $8 million valuation. Again, I'm just using shoot from the hip round numbers. And the 5 year plan that I had in mind for them was going to put them, closer to a $25 million valuation. And, I purposely, Rich, leaned heavily on kind of how aggressive my pro forma was for what we could accomplish with them in partnership over the next 60 months. And I anticipated that they were going to say, well, that's really aggressive, Geoff. Maybe we don't get to 10 million in revenue in the next 5 years. Maybe we settle for 8. And I, would have been, of course, super happy with that. And, I try to, maybe lean aggressive when I do something like that, so that we can maybe back into what the right structure is. Well, what I actually got from them was 180 degrees different than that. It basically said to me, not only do we not want to hit 10 million or 8 million for that matter, we actually think that we want to shrink. We think we want to shrink from 5 million to 2 million in revenue. And so conversations began to ensue regarding how they're going to do that. And obviously that's for quality of life reasons and things of that nature. So I think what I will say is that one of the benefits of working with an advisor or consultant like us that has experience not only in consulting, but also in some of the real value levers like recruiting and mergers and acquisitions in a particular space like we do. And there are other firms like us, but someone that has multiple service offerings, and consulting is one of them, in a particular space, is through conversation, maybe by process of elimination, you can actually help back into what the most natural path forward is. I think one of the biggest things that I hear firm owners struggle with, Rich, is some difficulty on direction, on destiny. There's so many tools available. There's so many theses that we see in the market. There are so many people soliciting you to buy your firm. There are so many people who are saying this is the next hot thing. How do you see the signal through the noise, specifically the one that's going to work for you? And I think that the best way of doing that is by talking to people who have a really purpose-driven agenda to edify you as to what is possible. And then you make the final decision as to what's best for you.
Yeah, I appreciate that, and that's gonna wrap up our conversation today around gross versus the adjusted EBITDA multiples. And you gave us a lot of thought-provoking and eye-opening things to consider. And whether a firm is building, they're buying, or exiting, or like being able to understand these numbers can make or break an outcome. So I appreciate the time today, and I appreciate all of our listeners as always. And if this hit home, share it with your peers, and we're always available, and we love having new listeners and a new audience. So until next time, when we will go into more kind of real deal anecdotes with you. So stay tuned for that one.
Thanks, Rich. See ya.
Yep. See ya.
Thank you for watching the Nexus Point. See you next time.